If you have all your retirement savings in pre-tax accounts, do you know what that could actually cost you? The 3 changes I'll walk you through today can be pretty straightforward to implement. I'll reveal all 3 critical changes today, but the second one might be the most powerful, and it may only be available during a specific window of time that many people completely miss. So let's start with the first critical change, and this one trips up many people. Here's what this might look like in hypothetical numbers. Let's say you need $80,000 per year to live comfortably. If you're pulling from a Roth IRA, you withdraw $80,000 and you're done. Clean and simple. But if it's all coming from your 401k, you may need to withdraw $92,000 to $94,000 just to net that same $80,000 after taxes. That could be a $12,000 to $14,000 difference every single year. And over a 30-year retirement, you may have to withdraw hundreds of thousands of dollars more than you originally planned just to get the same spending money. So before you set your withdrawal strategy, take a step back and factor in taxes. Here's the approach we suggest. Plan your withdrawals based on what you need after taxes, not before. Think of it this way. If you need $80,000 to live on, you need to withdraw whatever amount gets you to $80,000 after Uncle Sam takes his share. That could be $92,000, $95,000, or even more depending on your tax situation. Now here's that second change I mentioned, the one that may be the most powerful and is only available during a specific window. Think about a hypothetical couple who retires at 62. For the next 13 years until their RMDs kick in at 75, their income might be the lowest it's been in decades. Many people might waste this opportunity, but the smart couples, they could use these tax years to take control of their tax future. Here's what we mean. During those years between retirement and age 75, you may have flexibility you'll never have again. Your income may be low, so you're probably in a lower tax bracket than you've been in for years. This can be your chance to do several powerful things. First, Roth conversions. Move money from your traditional IRA to a Roth IRA. Yes, you'll pay taxes now, but possibly at a much lower rate than you might in the future. Second is strategic withdrawals. Pull money out of your pre-tax accounts while staying in a potentially lower bracket. This can give you more control over your future taxable income. Third, if you can delay taking Social Security, your income might stay low for even longer. This can create even more room for tax planning. Think of it like draining a bathtub slowly, rather than waiting for it to overflow all at once. When you hit 75 and those required minimum distributions start, the IRS decides how much you have to take out. You may lose control, but during this window, you can be in the driver's seat. Here's the thing though, this window closes. Once you hit 75, once Social Security kicks in, once RMDs start, your income may go up and your flexibility may go down. That's why this can be the most powerful strategy, but only if you use it before it's too late. The third change is about potentially protecting your family from a tax disaster you might accidentally be creating. Picture this hypothetical scenario. Your children are 45 and 48, both in their peak earning years, making good money. They inherit your $1 million IRA. Sounds like a blessing, right? Under current tax law, non-spouse beneficiaries typically have to empty inherited retirement accounts within 10 years. And those withdrawals, generally fully taxable. So your children, who are already earning good incomes, now may have to take out an extra $100,000 a year for 10 years. That money could potentially push them into the highest tax bracket, meaning 30 to 30% of that inheritance may disappear to taxes. Instead of leaving them $1 million, you may have left them about $650,000 and a massive tax headache. So what can you do? First, consider Roth conversions during your lifetime. Pay the taxes while you may be in a lower bracket so your heirs can receive tax-free income instead. Second, Think about leaving taxable investment accounts to your children. These can get what's called a step up in basis, which may mean much lower taxes for them. Third, if you're charitably inclined, consider strategies like qualified charitable distributions after age 70 and a half. You can donate directly from your IRA to a qualified charity, and it doesn't count as taxable income. These moves can help you pass on significantly more of what you worked for, potentially creating the lasting impact you probably intended. Now I'm curious, where do you see yourself in this? Are most of your retirement savings in pre-tax accounts? Have you thought about the tax impact on your withdrawal strategy? Let me know if this is making you rethink your strategy. Let's quickly recap those 3 critical changes. First, adjust your withdrawal strategy to account for taxes. Plan for what you'll actually net after the IRS takes their share, not just your gross withdrawal amount. And consider using those years between retirement and age 75 as your tax planning window. This may be your chance to take control before RMDs potentially take control away from you. And third, plan for the legacy impact. Make sure you're maximizing what your family actually receives, not just what you're leaving behind on paper. Remember, having most of your money in pre-tax accounts isn't necessarily wrong, it just may require a different strategy. The key is planning ahead and making these adjustments before it's too late. Now, once you understand these changes, the next question becomes, how do you actually minimize what you pay to the IRS every year in retirement? I cover exactly that in this video right here, where I walk through 3 specific ways to potentially pay less in taxes once you're actually retired. Take care, and I'll see you in the next video.